Hello everyone, and welcome back to our first BKL tax webinar of 2024. Hope you all survived the self-assessment season, and it's very nice to have you with us. Today we're going to be looking at employee share schemes and tax, and in particular we'll be focusing on EMIs, enterprise management incentives, but we will also doff our caps to some other share schemes and arrangements that are out there. So joining me, Tony Newgrosh, today is the very lovely Stephen Deutsch. Hi Stephen.
Hi, good afternoon, everybody.
Okay, but before we dive into share schemes, just a few words about life at BKL here. If you'll let us indulge ourselves for a minute, all very exciting. We've now got over 250 people here. Delighted to be joined by our friends at CF Pro, FSPG and Landau Baker. We've now got over 25 partners. We've got over 30 members in our tax team and growing all the time. And we're a top 50 accountancy firm and tax advisors and auditors, with thanks to our partners at CP Capital who are joining us on this very exciting journey. And as part of that, we're delighted to announce, confirm, reiterate that we are now a B Corp. So we are very nice people to do business with, and we are very mindful of our wider responsibilities. So that's a little bit about us. Also very proud to let you know, again, that we are Tolley's Taxation Awards Best Employer in Tax, are we not, Stephen? Thank you. And Accounting Excellence Awards Tax Team of the Year. And if there was an award for Best Looking Tax Team, Stephen, I think we'd be up there too, wouldn't we? So all good.
Some members might.
All good there. But enough of this. Let us just give you a flavour of what we're going to be covering today. Over to you, Stephen.
Yeah, we'll be talking about the two government-approved share option plans, which is the EMI, Employment Management Incentive Scheme, and the CSOP, which is the Company Share Option Plan. We'll also touch upon unapproved options and talk about other employee share incentives available. Just to give a bit of flavour about the two approved schemes, I've not seen any recent statistics, but 2021 statistics showed that there were 510 million shares under EMI options and 180 million under CSOP. And there were 14,000 EMI schemes created in the 15 years up to 2021, but only 1,500 CSOP arrangements. So I think you get the gist that the EMI is the most tax advantageous and the one to go for if you can qualify for it.
That's a lot of share options, Stephen, and as we'll see, there are good reasons for that. So just as sort of, again, the headlines, as it were, we're talking about tax advantage share options for employees, and shouldn't be forgotten, both of these schemes can indeed provide valuable tax breaks for the company that we'll look at. But EMI, very much the best deal in time. But as we'll cover today, there are many, many pitfalls in the legislation. So be careful when you're setting up such arrangements and do seek advice. So Stephen is our expert on such share schemes. So I'm going to let Stephen do most of the talking today. Stephen, over to you to take it away on EMI share options. Give us the headlines as to how these work.
We'll be talking about the next three items through the course of the next few minutes, but in order for an EMI share option arrangement to work, you have to have shares which are qualifying shares. The employees to who the options are to be granted must be qualifying, and the company itself must be a qualifying company. And as I say, we'll give more information about those terms
and of
as
course,
we go through.
Yeah, absolutely, Stephen. All of this is within the legislation. We're not going to be, I think, quoting too many section numbers today as the general idea, but of course it is important that everything flows back to the legislation. Most of it's in Schedule 5 there, Stephen, isn't it, of ITEPA?
That's right.
And we'll look at the detailed rules there, and we'll start with this one about the purpose of granting an EM option. You shouldn't forget as well, there are rules within the main body of ITEPA 2003, particularly dealing with disqualifying events. People tend to focus just on the schedule, don't they? But be aware, for whatever reason, they have effectively split the legislation in two, haven't they?
That's right. And as a definition on your screen says that a company will be able to grant options which are qualifying under EMI, but they must be granted for commercial reasons and to recruit or retain an employee in a company. And it can't be part of a scheme arrangement which is mainly to avoid tax. There are very few arrangements which would avoid tax, but I think bear in mind if you put an EMI scheme in very shortly before a sale of a company or an exit event, then that might be regarded as for the avoidance of tax.
I was going to say, Stephen, I've not seen the revenue challenge this point about being granted for commercial reasons in order to recruit or retain an employee in particular, but I think the point you make is valid. So, plan ahead, and as we'll see, these options can be a fantastic deal for staff, particularly in a startup business, can't they?
Absolutely.
Okay, so that's the purpose of granting an option. What we need to talk about qualifying shares, Stephen. What we're talking about here?
Well, the shares over which the options can be granted need not only be new shares which are to be issued by the company when the options are exercised, but they can also be over shares which are held by shareholders. They can be over existing shares, which is something which isn't always noticed by people who put share schemes into place.
Yeah, I mean, typically the options are granted over new shares, aren't they? But it shouldn't be discounted if you've got a shareholder who's also looking to divest of some equity.
Yeah, I think very often you'd have them over existing shares, firstly because of that, or secondly because the shareholders don't want to dilute their interest, whereas one shareholder is willing to do so.
Okay. And you said over ordinary shares, or we're saying over ordinary shares, Stephen. How is that defined for these purposes?
Well, an ordinary share or ordinary share capital is defined in the Income Tax Act 2007, and it's a company's issued share capital other than capital which have a right to dividend at a fixed rate, but have no other right to share in the company's profits. Any other type of share would be regarded as an ordinary share. But the thing to bear in mind is that it must be fully paid. You can't use partly paid shares, and obviously it's got to be a non-redeemable share.
Okay, and that's the normal definition of ordinary shares that we see for various other tax purposes, isn't it, Stephen?
That's right. So, but an ordinary share therefore can be a gross share. It could be a share that doesn't give right to dividends. It could be a share that doesn't have right to votes.
Okay, so you can carve out separate rights attaching to these shares, is what I'm hearing. Albeit in many cases they're not exercisable until a sale anyhow, are they, these options? So in reality,
if that's the terms of the option arrangement, I mean, you can have options which are exercisable subject to time-related terms or even performance-related, which are exercisable before an exit event.
All of which needs to be set out in the option agreement, Stephen. And this isn't just best practice, a lot of this. This is to do with what the legislation specifically says. So while Stephen just tries to get his screens back on, I'll talk you through some of these. So the option agreement, it has to be in writing. Okay. And it must state, well, go on, Stephen, take it away. What must the option agreement state?
The option agreement, well, firstly, it's got to be under a deed, or it's got to be able to provide legalities, so where consideration is paid. And the option agreements obviously say the date the option's granted, which is the date it's executed. It's also got to have a clause in it for EMI purposes saying that it's been granted specifically under the EMI legislation. And an option is only exercisable, must be capable of being exercisable within 10 years. So often we will find that the EMI option will lapse on the 10th anniversary of the grant. It can be for a longer period, so long as it's exercisable within 10 years. But if it is exercised after the 10-year period, then it will have lost its tax advantages. Just thinking about that, we've had the EMI arrangement in place for about 25 years now. It was introduced in 2000. So options which are granted in, say, 2014, late 2014 or 2015 will be approaching their 10th anniversary. And if you do have clients who have options which were granted 10 years ago or 9 years ago, you may want to be speaking to them about what action should be taken if they can be exercised before the 10th year anniversary. The option agreement's also got to specify the number of shares and the grant price, and also what the exercise price is. Often there isn't a grant price, but the exercise price, which can be as low as nominal value, but is very often the market value of the shares at the date of grant, must be specified. The option's got to say when and how the option may be exercised and whatever conditions and restrictions might attach. The conditions might be performance related, they might be time related, or there may be any other condition, but they've got to be reasonable and achievable. In fact, when the EMI legislation was introduced back in 2000, the actual legislation included the words achievable and reasonable, and that was dropped later on, I think, when the ITPA 2003 legislation was rewritten.
But just picking up on that, Stephen, let's be clear, these options can be tailored to each individual employee, can't they? So
absolutely.
Every employee can have different targets, which determine whether or not their options vest.
Yeah, there's great flexibility within the nature of an EMI arrangement.
And just to compare and contrast with CSOPs, as we'll see later, you said exercisable within 10 years, but there's no minimum period. They could be exercisable tomorrow, couldn't they?
Yes, that's right.
Yeah, okay. And typically, as you said, we'll do the maths a little bit later. Exercise price is typically market value. You can, am I correct, Stephen? You don't have to put an actual number in there. You can have, for example, the exercise price is whatever may be agreed with HMRC as the market value.
You could do, but it's normal to keep everything as simple and clear for the employee and for the company when they can't be exercised, and not to have formulas in there which are difficult to understand. The more complicated the agreement is, the more problematic it could become when it comes to understanding what has to happen in exercise.
Fair enough.
And the final point is restrictions. Those tend to be the restrictions which are in the company's articles or a shareholders agreement up to 5th of April 2023. One actually had to specify what those restrictions were within the option agreement or an addendum to it. Now you need no longer do that. That requirement was dropped on as from the 6th of April 2023. But you do have to say that there are restrictions which are and specify which documents those restrictions exist.
Okay, but I guess the headlines are this is a very formalised agreement, and as we'll see later, there is a notification to HMRC. So make sure you comply with all of these conditions, otherwise you do run the risk of your options being non-qualifying, which might be a difficult conversation to have. Okay, so thank you for that, Stephen. Let's crack on now and just talk about the maximum value of options that the company can grant and an individual can hold.
The legislation states two caps. One is the employee limit, which is effectively no employee can have EMI options which have an unrestricted market value, and I'll come on to that term in a minute, in excess of £250,000 as at the date of grant. So if an individual is granted options with values of say 10,000 in year one, 50,000 in year three, he's got 60,000, so he can't be granted further options over more than 190,000 pounds worth of shares at a future time. And so long as the company itself is concerned, it cannot have options in existence which exceed £3 million totally for all its employees within the group or within the company.
All right, that's at the time of grant again, though, isn't it, Stephen?
Yeah. Okay. There's one other point about it. Just talking about unrestricted market value. That means the market value of the company shares, ignoring any restrictions which might exist within the company's articles or shareholder agreement or any other document. So one's got to bear in mind that you may have agreed a value with the revenue of the actual market value of X pounds, but it's the unrestricted market value you're looking at for these terms. There's a 3-year period. If you have received options in excess of £250,000 and you exercise some of those options, you've got to wait another 3 years until you can be granted further options. However, if you've been granted options under that £250,000 limit, say 2,049,999, that 3-year period limit doesn't exist, and therefore once he's exercised some options, he can be granted further options up to 250,000.
Okay, so pretty generous limits, I think we would say, and we'll come on to dealing with HMRC a little bit later.
Just one other item, which is that 250,000 would exclude any unexercised CSOP options, as we'll come to speak about them in a minute, but the CSOP option maximum is 60,000. So you could have £60,000 worth of CSOP options and £190,000 worth of EMI options.
Must be pretty rare though, Stephen. You've got CSOP and EMI options at the same time, isn't
Well,
it?
As we'll come on to, you may have granted EMI options and then want to grant, because the company no longer qualifies for EMI because it's exceeded certain limits or qualifications, then you may want to grant CSOPs. You may have that sort of situation, but it's usually that way around, with EMI first and CSOP following on.
Okay, but pretty unusual. And apologies, I should have said earlier on, if you've got any questions, do feel free to type them in the Q&A box, and Stephen and I will do our best to answer them. If we don't have time during the webinar, apologies, but we will try and review and come back to you with our answers when we circulate the slides after this. So feel free to ask. We're here to help, as it were. So that's the maximum value of EMI options that an individual can hold and the company can grant. We also need to talk about who is a qualifying employee for these purposes, Stephen.
The first qualification for that is that you can't be granted an option if you're an employee who already holds 30% or more of the, or over 30% of the company's shares, and that could be directly or indirectly. And when I say indirectly, it might include associates, that means family members, parents, grandparents, children. It might include business partners. All these are aggregated when arriving at that 30% limit. But if you don't have 30% of the shares at the time you're granted options, you will qualify, and you can be granted options above 30% at that time. So you could, in theory, have a situation where you've got an individual, one individual who holds shares, and then grant over 100 shares, and then grant options over, say, 300 shares to the option holder. So he swamps the existing shareholder, but he won't have more than 30% at the time he's granted the option. He'll only go above that 30% limit after the option's been granted.
Yeah, common misunderstanding, that one. So thank you for clarifying. And what about their status, Stephen, as an employee or director?
Right, an employee or anybody who's an employee or director can be granted an option, but they've got to satisfy the working time commitment, which is either 25 hours per week or at least 75% of their working time, and that must be satisfied throughout the length of the option arrangement. So at any point, if you cease to meet those conditions, you'll no longer qualify. Just to give a little bit of meat to the bones of what they mean by committed working time, that a person who's injured or away from work due to ill health or disability, somebody who is pregnant or on maternity leave, even maternity leave are included within those 25 hours a week. And obviously reasonable holidays would also be included. And we saw during COVID that the government were willing to include employees who were put on furlough or reduced working time, did not lose the 25 hour per week condition, so continue to qualify. So there is flexibility within that, so long as it's reasonable and within the terms of the legislation.
Okay, thank you. So that's a qualifying employee. Now we need to talk about what a qualifying company is. Sorry, I've jumped forward a couple of slides. There you go, Stephen.
Yeah, the first type of company that will qualify is any company whose gross assets, and that means assets excluding liabilities, which excluding liabilities which don't exceed £30 million. The company can't have more than 249 employees. That means any company with less than 250 full-time employees will qualify. They've got to be full-time employees. So if you have a company with a number of part-time employees, you have to do the maths. I think they work it out on a weekly basis, 35 hours a week. So you would sort of apportion the part-time employees to arrive at the number of full-time employees you've got. One of the most important areas is that the company must not be under the control of another company, and that's where we do find companies who may have granted EMI options suddenly finds that they no longer qualify because they might have entered into an arrangement where they've given another company the right to purchase control of the company at some future date by option, for example, or the other qualification is that the company cannot have a subsidiary in which it's got less than 51% of the shares. Control of another company is not only where one company controls more than 50% of the shares, it would also include a shareholder who may have control of the other company. So you could have a situation where another company controls 40% of your shares, but you have a shareholder within your company who's got 11% control of the other company, and that would take you over the 50% limit.
Okay, one of my claim to fame is that less than 250 full-time employees wasn't originally there, was it, Stephen? It came in, it was about 20 years ago, I seem to recall, and my client, unbeknown to us, applied, issued what they thought were EMI options on the very day that rule took effect, and they had 275 employees, so they were the first company to be rejected under that provision. Talk to your tax advisors first, I think, is the moral of the story. One of the things, though, we have to be careful of is there are certain qualifying trades, or let's be clear, probably the other way around, isn't it? There are certain trades that are not qualifying for EMI purposes, and the rules are slightly different depending on whether you are a singleton trading company or part of a group. So, Stephen, do you want to just talk us through how the rules apply here?
Yeah, when you're a singleton company, the legislation requires that company to exist wholly for the purpose of carrying on a qualifying trade. I mean, you can ignore any event which is incidental, but it's effectively got to exist wholly for the purpose of carrying out its qualifying trade or preparing to do so. So therefore, any non-trading activity it carries out cannot be significant. And finally, the company's got to have a permanent establishment in the United Kingdom. That might mean, well, the legislation does go into detail as to what's meant by permanent establishment. It could mean an office, it could be a subsidiary company.
Okay, but as we said, the rules are subtly different for groups, aren't they, Stephen?
Yeah, they're a bit more relaxed for a group because where you have a trading group, you've got to have at least one company in the group that meets the singleton company qualification. But the group as a whole doesn't have to be wholly qualifying. It's got to qualify as long as it doesn't have a substantial part of its trade is carrying on qualifying activities. Now, substantial is not defined, but the revenue except a figure of around 20%. So long as the group as a whole carries on non-qualifying activities that can be regarded as not exceeding 20% of its trading activity, which might be time spent, might be value, might be profits, might be turnover. There are a number of issues to look at. That group would qualify, but it's more relaxed than a singleton group, the singleton company.
Okay. So that's substantial, as you say, somewhat unsatisfactory that it's not defined in the legislation, but 20% as a rule of thumb, as we see in other tax provisions. Let's just talk about these qualifying and disqualifying trades for these purposes, Steve, and then perhaps we can come back to a couple of questions we've had on the working hours tests. So what are the exclusions?
Well, as you can see in front of you, they're really split between property-based types of companies, where companies deal in land and other types of property, asset-backed trades. They're companies within the financial markets, deal with commodities, shares, securities, banking, asset hire businesses, shipbuilding, coal and steel is obvious, and royalties and license fees. Just coming back to royalties and license fees, you can have a company which does receive royalties and license fees as its predominant income, but that would qualify only if the IP, the intellectual property behind the royalties or license fees, was either developed wholly by the company or acquired by the company and then exploited and developed by the company. There are certain percentages it's got to satisfy, but a company that has its source of income from royalties and license fees can qualify in certain circumstances. And just finally, not on that list, accountancy and legal firms are also excluded.
I know, outrageous, isn't it? I was going to mention that. You mentioned banking and money lending. I think people tend to talk about financial activities. I think the only point I would add there is the revenue says it has to be broadly your own money at risk. So if you are a financial advisor, for example, in theory, you should still be qualifying, subject to all the other normal tests in there.
Well, that's right. And also an estate agency would qualify, even as long as they're not dealing in land themselves. All they're doing is acting as brokers.
So if you're sort of broking in the middle, as it were, and it's not your money at risk. So all good. Okay, Stephen, if we may, we've had a couple of questions on the working hours test that I know always causes difficulty. James is asking, an employee could work less than 25 hours and qualify, is that correct?
That's right, so long as they spend 75% of their working time on the companies, working for the company. So you can have an employee who does 20 hours, but that 20 hours has got to be 75% of his or her working time for the company.
And I think Brian's making the same point, or asking the same question. If you've got somebody whose only job and they only work 15 hours a week, so for part-time employees, I think you're saying because they are devoting at least 75% of their working time,
they will qualify.
They will qualify as well. So it's an either-or test. Okay, I hope that clarifies. But
there's one other loophole which the revenue or the legislation has blocked when it comes to qualifying companies. It's called provision of facilities for another business, and what this is intended to prevent is where you've got a company which is carrying out a qualifying trade itself, but is providing those services to a related company which is carrying out a non-qualifying trade, where the shareholders have a 30% interest, or the controlling shareholders of the other business have a 30% interest in the qualifying company, then that company will also not qualify for EMI options. I hope I put that clearly. It's not that straightforward.
Okay, so that's similar to the anti-fragmentation test that I think is also copied in the EIS rules, isn't it? To stop you sort of carving out part of the business that's not qualifying and having, say, an administrative service provided to that business that you try and argue is qualifying. We try and look at it in the round, I think, is the gist of it. Okay, thank you for that, Stephen. Let's talk about our friends at HMRC then. What do we need to be mindful of here? What are our obligations, Stephen?
Well, there are a number of steps when you want to put an EMI scheme into place. One is to make sure that the company is a qualifying trade. Now, very often that will be fairly obvious that it is, it is a qualifying trade. It's not on that excluded list, but there may be certain doubts. It may be carrying on something which you're not certain about, and you can approach HMRC and seek an advance assurance from them that the company is or is not a qualifying company, and therefore get their agreement that it can grant options. Obviously, that will only be at the point that they give their agreement. If the company's trade subsequently changes and into an excluded activity, then they will no longer qualify. The second point is, although it's not mandatory, it's always wise from our point of view to agree the value of the option shares with HMRC in advance, which gives the company and the employee certainty, especially, you may feel that the 20p per share that you valued the company at is correct, but the revenue have the right to review that when it comes to exercising the options by seeking their agreement up front with the share valuation division. You have that certainty that when it comes to the exercise of the option, so long as you've given them all the pertinent facts, they won't challenge the exercise price and whatever the tax liability arising on that might be. If you have sought an EMI valuation agreement with the revenue, then you have 90 days from the date of the agreement letter received from the revenue to grant the options. If you fail to do so, then you'd have to apply for a fresh valuation.
Okay, I mean, just a couple of thoughts on that, Stephen. I mean, far be it from us to criticise HMRC, but we would never do that. But I think generally, would it be fair to say they're pretty reasonable with the share valuations, and they're fairly amenable to what would be considered as long as we are reasonable, as it were. We tend not to get too much pushback from HMRC.
We have had pushback and agreed things with them when they haven't always agreed the valuation submitted. But on the whole, if the valuation is put in on a sensible basis, that they will be agreeable to it.
Okay, and just to reiterate, I think what you said about advance assurance from HMRC, one, it's only as good as the facts as you give them, and two, it's only as good as the facts at that point in time. The business may have moved on since that. So, I think shareholders, or even employees in this case, you need to be a little bit careful, as it were. HMRC aren't 100% bound by that, as it were, but in reality, if nothing has really changed, then it should give you comfort, and the company comfort, that they can issue qualifying options. Okay, we're going to have a quick look at CSOPs now. I think it'd be fair to say if EMIs are the Manchester City of share options, then CSOPs are very much the Arsenal or Liverpool, I guess, Stephen. And for the benefit of Spurs fans, we'll come on to unapproved options if we've time a little bit later. But
I think I should walk out at this point. But
well, moving on, just compare and contrast what we have with CSOPs to EMIs, and then we're going to do some calculations just to, I think, highlight the point that we're making, that EMIs are indeed the best value in time. So, Stephen, take it away. What are the key features of a CSOP?
As I said in the introduction, CSOP option grants have been far fewer than those under EMI. The CSOP arrangement was introduced as long ago as 1984. It was called the Executive Share Option Scheme, for all those who may have been practicing at that time. The rules were slightly changed in 1996, which is more or less the basis of the legislation we've got in place now, although significant changes were made in last year's Finance Act. So as from 5th of April 2023 or 6th of April 2023, there are certain relaxations introduced which makes the CSOP a little bit more popular than that you might have thought it had been. Now, a CSOP is a tax qualified share option plan, but there's no limit on the company size. So a company with over £30 million worth of gross assets will qualify. A company with more than 250 or more employees will qualify, and a company that carries out a trading activity which is on the EMI excluded list will also qualify. Options can be granted to any employee or director of the company, but one's got to bear in mind that if you're a full-time director, or if you're a director full-time or not, you've got to work for the company for 25 hours a week. But if you're just an employee, there is no working time commitment. You can be working for the company for fewer hours and still qualify under the CSOP arrangement. The exercise price, in contrast to EMI, must be not less than market value. I think the revenue or the legislation says it must be not manifestly less than the market value, and that market value is the unrestricted market value of the shares. As from 6th of April 23, when the employee limit was increased from 30,000 now to 60,000, which makes the CSOP arrangement that little bit more attractive. So as at the date of each grant, an employee can have up to £60,000 worth of CSOP option shares. The one major difference is the subject to certain minor qualifications. The CSOP options must be held for at least 3 years following grant for them to qualify for the tax advantage status. And finally, the gain on disposal of shares is subject to capital gains tax, not income tax. And the reason for that is because the exercise price is the market value at the date of grant.
So a bit more flexibility here, I think, is the highlight, Stephen, albeit, say, not as generous. You can't exercise for 3 years, 60k limit, etc., as you've covered for us on that slide.
The shares, just one other point, the shares must be ordinary shares, as with the EMI arrangement. And the company can't be under the control of another company, except where the company that is controlled is a company which is itself listed on a stock exchange. And finally, this is a point I didn't mention earlier. When it comes to a company being controlled, both under the CSOP legislation and the EMI legislation, you can have a corporate trustee where the company's shares are held, have an ESOT, an employee share option arrangement, or sorry, an employee share scheme arrangement or a SIP arrangement in place.
Okay, we've had an anonymous question, Stephen. So let's see if we can do this. Can options which were granted at fair value, as agreed with HMRC, have an exercise price of less than that agreed value?
Yes, under EMI, that is, not under
Yes,
CSOP.
this is EMI.
But yes, I mean, that would, if you do grant the option at an exercise price which is below market value, agreed with the revenue, or what you consider to be the AMV, the actual market value, which is the value of the company, including any restrictions which attach to the shares, you can grant the options at any value below that, as long as if they're new shares, the option exercise price must be at least the nominal value of the shares. If they're granted by another shareholder, they can be granted with no exercise price at all. We'll come on to an example of the income tax and capital gains tax effects if you do grant options at a discount to their market value at the date of grant.
Okay, well then let's crack on then and start looking at the tax consequences under an EMI and a CSOP, and we can compare and contrast. So under EMI, Stephen,
yep,
take it away.
Under EMI, there's no tax on the grant of the option, and similarly, there's no income tax if the exercise price is equal to or more than the market value at the date of grant. But tax is payable if the exercise price is at a discount to the market value of the date of grant, which is the point we just discussed in response to the caller's question. But the tax charge is limited to the amount by which the market value at the date of grant exceeds the exercise price. That's the income tax charge is limited because there'll be capital gains tax on the excess.
And again, we'll put some numbers to all of this in a second, but if there is income tax payable, Stephen, when does the tax point arise?
The tax point arises depending upon the nature of the company at the time the option is exercised. If the shares are regarded as readily convertible assets, which means there's a market for those shares in place because possibly the company is a quoted company, or possibly there's an offer for the shares at the time the options are granted, or there might be an internal market for the shares, then pay as you earn and national insurance would have to be applied to that income tax liability. If those circumstances don't exist at the date the option's exercised, then you would account for the tax, or the employee would account for the tax through his personal tax return under self-assessment, which could give them a major advantage in holding the money, because he won't be liable to tax until the January following the year of assessment in which the tax charge arises.
This exercise is when we have to worry about the income tax liability, yeah? Not grant.
Absolutely, yeah. There's no liability until exercise.
Okay, so let's have a look at an example, looking through the square window, Stephen. So this is an EMI option that's granted over 1,000 shares. 1st of March 2020, exercise price is £1 a share, which is below the market value of £10 per share. Hold that thought. And we exercise the option. The shares sold in March 2025. It's good news, £100 a share. So, Stephen, do you want to talk us through the tax consequences of all of that?
Fees of £10,000 on the sale of his shares. That's the 1,000 times 100. But he's got an income tax liability on the difference between the market value at the date of grant and the exercise price, which is £9 per share. So he's going to have to pay income tax on that £9,000. If he's a 40% taxpayer, he'll pay tax of £3,600 at that time.
Yeah, and we're assuming, we'll come onto this in a little bit later, that these options remain qualifying all the way through, aren't we, Stephen?
Yes.
We'll talk about disqualifying events and the impact on that very shortly. So that's the income tax, which, as we said, arises solely because his exercise price is below the market value at the time of grant. And then he sells the shares. So talk us through this, Stephen.
Yeah, if he sells the shares at the same time or later, he'll pay capital gains tax, and the capital gains tax is limited to the market or the proceeds at the date of disposal, which is £100,000, less the amount upon which he's paid income tax, which is £9,000, and the excise price for £1,000 he's paid. So he'll have a gain of £90,000. Capital gains tax is payable at a rate of 20%, but in certain circumstances, he may qualify for business asset disposal relief, which reduces the rate of capital gains tax to 10%. BADR, as it's known, it used to be entrepreneurs relief, and for reasons unbeknown to anybody else, the name was changed to business asset disposal relief when they reduced the entrepreneurs relief limit from 10 million to £1 million as the lifetime limit. But BADR is available so long as the option was granted more than 24 months before the sale of the option shares, and so long as the employee, the grantee, the shareholder has been an officer or employee of the company throughout that 24-month period. The one major advantage over an ordinary shareholder is that if you're an EMI option holder, you don't have to have held 5% of the issued share capital of the company, or the voting rights, or any of those qualifications which require you to have 5%. Even if you've got a 1% interest or 0.01% interest, you'll qualify for business asset disposal relief so long as you've satisfied the 24-month period. So in this example, he'll pay tax of only £9,000 with the benefit of business asset disposal relief. Remember, business asset disposal relief is up to lifetime gains of £1 million. So we're assuming that he's not exceeded that, and effectively that will give him, taking account the income tax and the capital gains tax amount he's paid on this gain of 100,000, he's got a effective tax rate of 12.6%, which is very good news.
And I mean, we should just highlight, shouldn't we, the points you've made there, Stephen, that this is one of the key advantages of business asset disposal relief, isn't it? Don't have to have, if EMIs give you these BADR advantages, you don't have to have the 5%, and the clock starts ticking from when you were granted the options. I mean, we had one client here, we had employees who were granted options on a startup. They had 5 shares each, they paid £1 each. The options were exercisable on a sale, so they actually only held the shares for, well, a matter of nanoseconds, and they all received very sizable sums on which they paid 10% tax, having laid out £5 for the privilege of being invested in the business. So it can be really, really hugely tax effective, and certainly worth considering. And the only point just to add there, we've ignored the annual CGT allowance here of, well, it's now 6,000 going down to a miserly £3,000 next year in calculating the CGT due. But it wouldn't make a great deal of difference, as we've said. So those are the calculations. Let's just move on to CSOPs, Stephen. Again, similar example here. So granted options over 1,000 shares on the 1st of March 2020 again. Here the exercise price you've got is £10, and I assume that's because you can't grant CSOPs at below current market value. So that's the best we can do. And the legislation actually says manifestly less, doesn't it, Stephen? I don't think we know exactly what manifestly means.
That's right.
Yeah. But our belt and braces would always say,
at the end of the day, when it comes, whereas under EMI there is no requirement to agree the value with HMRC, under CSOP you would agree the value up front. There is a requirement to do so. So it's going to be the value of the unrestricted market value of the shares that you've agreed with Share Valuation Division of HM Revenue and Customs.
Okay, but all good, but we have to grant at this agreed value, which we're assuming is £10 being the current market value, and that's the unrestricted market value. And again, we're going to exercise and sell the shares in March 2025, so all good as far as that 3-year holding period goes. And you get £100 again per share. So let's have a look at how the CGT position and the income tax position looks on this case, Stephen.
Because the exercise price is the market value of the date of grant, there is no income tax liability. So all we're left with is a capital gains tax liability, as Tony said, he's satisfied the 3-year holding period, and he may have also held the shares for more than 24 months, so he might be entitled to business asset disposal relief. But just going back to the calculation, he's received proceeds of £100,000. He's paid an exercise price of £10,000, so he has to pay capital gains tax on his gain of 90,000, subject to a claim for BADR of 20%. If he has at least 5% of the shares at the date he exercises, sells his option shares, and he's held those shares for at least 2 years and been employed for 2 years, then he may qualify for the 10% rate, and then he would only pay tax at £9,000 on his gain of 90,000.
Yeah, in reality, as we said, usually, well, in many cases, it doesn't have to be, of course. These options are only exercisable on the sale. So it's, in practice, quite rare for CSOP shareholders or option holders to qualify for BADR, isn't it, Stephen?
Unless he has an independent 5% holding.
Yeah, not impossible, but in reality, far more difficult than under an EMI, I think it'd be fair to say. So again, ignoring the annual CGT exemption tax of 18,000, if we compare and contrast, Stephen.
Yeah, the bottom line is, under EMI, having deducted the excise price, the income tax payable and the capital gains tax payable, he'll be result with a net spendable income of £86,400, whereas under a CSOP, because he's paying the capital gains tax at a much higher rate and has to pay the full excise price without a discount, he ends up with £72,000. CSOP is still a very advantageous tax arrangement if you can't go through EMI, but you can see there's a major contrast between the two if you can qualify for EMI.
Yep, a clear winner there. Okay, thank you for that, Stephen. Just to come on to one quick technical point, and this is, well, really a topic we could do and probably should do a webinar in its own right on Section 431 elections. So I guess the headline here is what we're talking about. These are if you have what are known as restricted shares. So there are rights that depress the value of the shares. Broadly, under the employment-related securities rules, you have a choice. You can pay tax on the actual market value, bearing in mind those restrictions at the time you receive the shares, but then you run the risk of further income tax charges every time those restrictions are lifted, varied, or the shares sold. The alternative is to make a Section 431 election to pay income tax on the unrestricted value up front. Why might you do that? Because it sets aside any further income tax liabilities as those shares are sold or those restrictions fall away or similar. Is that a fair summary, Stephen?
Yeah, I mean, I think the major advantage is that none of the gain, if you have a Section 431 election in place, then none of the gain can be subject to income tax, and you'll pay capital gains tax rates of 20% or 10% as they stand at the moment. EMI has some very special rules relating to the Section 431 election, in as much as that if the market value, that's the AMV, the restricted market value at the date of grant, is not at a discount, or the excise price is not a discount to the AMV, then the legislation deems a Section 431 election to be made, and again, you can't be obliged to pay any tax when the shares, income tax when the shares come to be sold. If the market value is at a discount, or the excise price is at a discount to market value at the date of grant, then you would almost certainly make a Section 431 election. That doesn't increase your tax liability, it just protects you from any income tax liability when you come to sell those shares.
Yep, as I say, that's perhaps a more detailed topic for another day. So time marches on, so let's crack on, Stephen. I think we largely covered this, but do you want us to talk about EMIs and pay-as-you-earn stroke NICs?
Yeah, I did cover this earlier, that if the shares are already convertible assets, that means they're shares which can be converted into cash at the time, or very soon after, or at the time that the shares are sold. They'll be subject to pay-as-you-earn and NIC. The income gain arising on the option shares has to go through the payroll. there's normally terms in the option agreement that requires the employee to repay the company any PAY tax that are deducted. If the PAY tax isn't repaid by the employee, then the employee can find himself with a double tax charge. He might repay it after the 6th of July, following the year in which the company has paid the tax, but he could also be taxed on that benefit. So it's very important that you do have that term in the option agreement. And the option agreement can also contain an election which requires the employee to bear the employer's national insurance contribution. It's very rarely enforced, but it's normally put in the option agreement, and it's at the discretion of the employer to decide whether he wishes the employers to bear the employer's share of NIC as well as the employee share.
Okay, but look, I think if we were to summarise EMI options, as we said, best deal in town, hugely beneficial for employees, a great way for companies to incentivise those employees without having to lay out real cash, as it were. But there's another huge advantage for companies here, isn't there, Stephen?
Yeah, the company themselves, as with other share options or where shares are made available to employees, is entitled to corporation tax relief. Now, normally the corporation tax relief is on the market value of the option share, or it mirrors the employee's income tax liability. So where an employee is given shares, he will pay tax on the market value of those shares, less whatever he's paid for them, and the company will get a corporation tax deduction on the same amount. When it comes to EMI, even though the market value of the option shares, or the amount the employee has paid for the option shares, the exercise price is the market value at the date of grant, which is below the market value at the date on which he has sold his shares, the company is still entitled to that corporation tax deduction on amount which equals the market value of the option shares at the date of exercise less the option exercise price that's been paid. And also bear in mind that this deduction is available regardless of whether it's the option is over the issue of new shares by the company to the option holder, or if there are existing shares which are being granted by another shareholder to the option holder, there will still be that corporation tax relief available to the employing company.
Yeah, no, good point. And I think we should say this isn't just relevant in respect of EMI options. This is any issue of shares, be it shares going directly to employees or exercise of options under an EMI, under a CSOP, or indeed even if they're unapproved, Stephen.
That's right.
Yeah, it does have its own conditions, but I think it'd be fair to say if an employee's received EMI share options, then the company should be entitled to that corporation tax deduction as well, which is very, very valuable. So it's rare in tax where it's a win-win, as it were, but I think this is probably one of the few examples, isn't it, Stephen?
That's right.
Okay.
And just one further point on that market value is not only the amount he received, but if there deferred consideration in place, or you've got to bring in the full market value of the shares at the time the option is exercised as a sale of those shares.
Okay, right. One other technical point is, there we go. What if there's a reorganisation here? Typically, say if we put a holding company on top, I guess the key concern here is, have you all of a sudden done something that means your EMI options are no longer qualifying because you're now granting options in a subsidiary company? There is some good news or relief here, Stephen, isn't there?
Right. When the straightforward reorganisation takes place, you've just put a holding company above the existing company, and the shares of the holding company, new holding company, effectively mirror that of the target company or the subsidiary. The legislation allows you to regard the EMI options which were granted to stand in the shoes of the old options. So although you have to go through a number of hoops, you have to actually issue replacement options, and you have to notify those options to the revenue, which you would do with new options. The employee will not lose his EMI options tax advantage status on his option shares. Similarly, so long as the option agreement permits it, where an offer is made by a third party to acquire the company, they can provide EMI options in the purchasing company to the employees of the target company which stand in the shoes of the original options. So instead of the option holder exercising his options, he can be put in a position where he can accept new EMI options in the new parent. There's certain conditions that have to be satisfied, so long effectively that the market value or the value of the option shares are no greater than the option shares which they're replacing. But that could be good news if the employee feels that the new company offers promise and greater profitability to him.
Okay, but again, the headline is if there is some sort of reconstruction or reorganisation, particularly the insertion of a new holding company, we can still protect the existing EMI options, but there are a few hoops to jump through there. So seek advice as necessary. Okay. The next point is really very important as well, and these are disqualifying events. EMI options are not just sort of fire and forget. Once they're granted, they're out there. We do need to be mindful going forward that the company continues to be qualifying, otherwise it can have tax consequences that Stephen will enlighten us on.
Yep. I think we've alluded to through the course of this webinar, there are a number of events that could happen, which means the company loses its EMI status. Unlike EIS, where you also can have a company disqualifying, there is no 3-year holding period. The company has to be a qualifying company throughout the life of the EMI option. So a disqualifying event will occur when the company becomes a 51% subsidiary, if it ceases to carrying on qualifying trading activities, if the employee himself or herself cease to be eligible because they don't meet the working time commitment, that's the 25 hours a week or 75% of their working time, or if the company decides that the terms of the option they put in place were not reasonable or made it too difficult, and they vary the option terms in a manner which are regarded as the creation of a new option agreement, that they will disqualify the terms of the old option. And also if there's an alteration of share capital where the value of the shares is affected, so that the shares themselves cease to be qualifying option shares. Now, there is some good news here. If there is a disqualifying event, the option can be, if the option is exercised within 90 days of that disqualifying event, then the option holder will not lose any of the tax advantages, including any BADR when he comes to sell the shares. But if the options are exercised after the 90-day period, then there is a sort of a time apportionment of the option at the time of exercise. You'd look at the market value at the date of the disqualifying event and apply the EMI rules to that, and the income gain arising after that disqualifying event are similar to the tax treatment of unapproved options, where you'd be taxed on the market value less the amount paid, the full market value of the shares, but not linked to the market value of the date of grant. So it is a complicated calculation if there is a disqualifying event, but there is some good news if that occurs.
But the headline is you've got 90 days. Beyond that, the longer you wait, the more the benefits of EMI start getting washed out, I think is what we're trying to say, Stephen. Yeah.
And just going back to CSOPs, that you do have a similar period where the option has to be exercised. For example, as a takeover of the company, but it's a 20-day period, not 90 days.
That's pretty tight, isn't it? So be careful. Okay, thank you, Stephen. So yeah, as I say, keep an eye on that. If there is an event that could be a disqualifying event, seek advice, because you do need to act quickly in order to protect the benefits of EMI for your qualifying employees. So finally, Stephen, just talk us through what we have to do as far as notifying HMRC and our annual obligations.
Yeah, there are certain responsibilities of the employer when they grant EMI options, compliance obligations. Firstly, up to this year, you have to notify HMRC within 92 days of exercise of the EMI option. So, the option is granted on the 1st of January, then you've effectively got till the 1st of April to deal with the notification. If you don't notify, then the option will lose its tax advantage status. With effect from 5th of April or 6th of April 2024, they're changing that so the notification has to be made by the 6th of July following the tax year in which the option is granted, which is what you have to do with CSOP option notifications. So there's a relaxation there. The second responsibility is to complete an annual return, an EMI annual return. That's mandatory filing. It's got to be dealt with online, and it's got to be filed by the 6th of July following the tax year to which it relates, and automatic penalties for late filing are charged. They're £100 for failing to file by the 6th of July. They increased to £300 on top of that if by the 6th of October. There's another £300 if they're filed not filed by the 6th of January of the following year.
Okay, I mean, we have seen it not by our good selves, I'd hasten to add, Stephen, where firms have gone to all the time trouble and expense of issuing EMI options, but fail to make the HMRC notification, which, as you say, is fatal. Do they accept late excuses in these circumstances?
They were much more flexible during the COVID period, where if a reasonable excuse was given, the revenue were a little bit more amenable. But in general, they're fairly strict on the 92 days of exile, unless there is a very good excuse for doing so. But there is a facility to put in an excuse and see if they will agree to it.
So you've got a chance, but not much of one, to be honest. So look, get it done is the bottom line, and make sure it's done in good time. All right, thank you for that, Stephen. We thought we'd just finish off by mentioning some other share incentives. Of course, we've been talking about approved schemes here. There are others. You could have unapproved share options that are completely flexible. You can give who you like, as many options as you like, exercise when you like, irrespective of the size or the company's business, but not tax efficient. Effectively, to the extent people are acquiring shares at less than their market value, that's, well, effectively a benefit in kind on which you'll pay income tax, and under PAYE if they are readily convertible assets. Growth shares are very popular, again, one for another day, but you grant shares that only tap into future value in the company. So the theory is they have no value now. Typically, we'd have some sort of hurdle above the current market value just to hopefully reinforce that they've got zero value now, because we'd all take the shares, wouldn't we, otherwise? But growth shares can be a popular way of incentivizing staff. Doesn't even have to be staff, anyone, to take some equity interest and tap into the future growth in the business. Or partly paid shares, where you accept that you're going to have to pay full market value for the shares, just not now. So typically you would, out of your sale proceeds on an ultimate sale, you would pay back. Now, of course, the downside to that is you are on the hook should, God forbid, the company go under for that unpaid part of the share capital. There can also be a benefit in kind to the extent you haven't paid for that share capital, albeit for trading companies, often that is set aside. So there are other things we can do here, but look, I think we end on the note we started, that EMIs very much are the best deal in town. Definitely worth thinking about. The sooner you think about it, the better for new growing businesses. They're a brilliant way to incentivize staff, and they come with huge tax advantages for the employees and the employer. Of course, here at BKL, we can assist with any EMI share option or CSOP you'd like to talk about, be it as far as the planning, the implementation, discussing with staff, finessing those conditions for each individual, agreeing the valuation with HMRC, and dealing with the annual compliance that Stephen just talked about. So do feel free to drop us a line. For now, just to say thank you, Stephen, for talking us through all of that. We will be sending out a copy of these slides to you all, and a link to the webinar should you found it so good you'd love to listen to it again. But if you'd like to share with your colleagues, feel free. But there are contact details if you'd like to pick up on any of these matters, have any questions, or indeed need any assistance in the future on any share schemes you're thinking of implementing. For now, though, thank you all very much for joining us. Thank you again, Stephen, and we hope to see you again soon. Bye now.